at various alternatives. So you have various alternatives to invest your money. So whenever we talk about the long term, right? So how do we know which proposal is going to be better? Where should I invest? Which one is the better one? So all this, when I talk about future, the base concept is time value of money only. We'll be using the discounting concept. That is 1 divided by 1 plus r to the power of n. So discounting concept only will come with regards to, tomorrow after 10 years, maybe I'll get this amount. So what is the present value of that amount? If I know that, I will be able to analyze whether the budget what I am going to spend on, is it viable, feasible or not? So what is capital budgeting all about? We have various investment sources, where we can see and we can plan out and invest. So generally the capital structure are influenced by factors like funds, capital structure, policy of the government, taxation policy, the earnings, the capital return, working capital, the accounting process, your earnings. All this would matter a lot whenever we talk about your investment. So what is capital budgeting? As we were talking about, we have working capital management for your day-to-day needs. For a long term, investment in long term. So what do? We have to go with capital budgeting. So capital budgeting is long-term planning for making and financing proposed capital outlays. This is the definition given by Han Green. So what he says is, for making and financing proposed capital outlays, means if I want to invest a huge amount for future, for a long term, that is called capital budgeting. So investing firms money into, or giving, investing or it's funds for, addition, that's expansion, disposition, modification, replacement of assets, whatever the reason be. You want to go for a capital expenditure, a major expenditure, a huge expenditure, which would be for a sustainment of the business. All those would come under the heading capital budgeting. So when I talk about capital budgeting, so what do we have in this? So whenever we talk about the projects, so what is the process which capital budgeting? First is generating a project. Once the project is generated, we need to evaluate it. Evaluate it to some scientific methodology where we can rely on that. And then we select the project, which one is good enough based on the decision making, based on the project evaluation of the project. And then we'll execute the project. So this chapter, capital budgeting, we will learn as to how the capital expenditure, where do we have to spend, how much are we spending, and then what are the various methods we could go with it. So right, whenever I talk about methods of capital budgeting, we have various methods, which includes the traditional methods and the discounted cash flow or the modern methods. As I already told you, the traditional methods doesn't talk about the time value of money. It talks about only the old methods. Here also conventional methods go with the payback period, accounting rate of return method. And your modern method deals with the discounted cash flow internal rate of return, profitability, profitability index method. These three would go with the discounted cash flow technique. So we'll just see what is this payback method. Payback method refers to the period in which in how many years you would get the investment back. Suppose I say I am investing today 1 lakh rupees. Am I audible? Are you listening to me? Are you all there?
Yes, ma'am.
Right. Suppose I say we are investing 1 lakh rupee. Now in 1 lakh, say I get 10,000 per year. What is the payback period? 10,000 per year. I can make or get back my investment in a period of 10 years. 10,000, 20,000, 30, 40, 50, 60. In this way, I calculate it will take 10 years period. So that is the payback period. You're able to get me. So what is the investment which I am investing and what is the amount or period, the period in which I'm going to get back my return. So when I talk about this payback period, it is a traditional method of evaluation, and the formula for this moves like the original investment of the project divided by annual cash inflows. Very simple to calculate. The payback method is a very, very commonly used technique because it's a traditional old method. It's a very easy method. Simple calculations. Selection or rejection, you can understand by the period time which you have, the rate of interest which you would want. Based on that, you can do, and it is best method when we talk about the high risk projects. So high risk projects, if I go with very, very high time, maybe it will be more risky. So what are the disadvantages is the rule of the thumb. It just goes by the principle only by the period at which I can do. Time is not considered. The value of money is not considered. Right. The economic life of the asset is not considered. The pattern of cash flows are not taken. Means, am I getting a, say, 10,000 first year, 20,000 second year, 30,000 third year, 40,000 fourth year? An incremental pattern of returns or an even pattern of returns. We don't bother with that. And it does not reflect all the relevant dimensions of profitability. That's the main thing. So whenever we talk about the payback period, we'll just see. We will see one problem. Here, a company is considering to purchase a machine. 2 machines are there, X and Y. They are costing 50,000. And inflows are expected to be as under. He has given you machine 1, machine 2, machine X and machine Y. So we have to see at what period we would get back our money. So what is the payback period formula? Original cost of investment by the annual cash inflows. So here we have to take the cumulative cash flows. Get this. Because annual cash flow is not even year. So if you write down the cumulative flows, it's very easy. Okay. So first year, what is the amount which is spending is 50,000. Now, how do I do? $50,000, look at this. First year, I'm getting 15. Second year, I'm getting 20. Third year, 25. So 15 first year. Second, 20, that is 35,000. 35,000. In the third year, I need only 15. I'm getting 25. So my period will be somewhere between 2+ years, below 3 years. Hello? I think someone's audio is on. Check it. Right. So I will have to calculate that. So how would I do? First year I'm getting 15. Second I'm getting 20. That is 35. Now what is the balance which I need for 50? Because the investment initially is 50,000. Rupees 50,000 is what is the base value, outlay. So 35,000 I'm receiving in the first 2 years. How much more should I require? I require 15,000 more. So that 15,000 divided by how much am I getting? 25,000. How much period do I want? I need 0.6 years. Yes. Yes, is it something? Are you all able to understand?
Yes, ma'am. We are getting you, ma'am.
Okay. Because I find some disturbance somewhere. Okay. So how many months would I require? It is 15,000 divided by 25. That is 0.6 years. So how much do I require? First year 15, second year 20, 35. I require 50,000, 35 is already come. How much do I require in the third year? Only 15. So 15,000 divided by 25,000 will be given the number of years. It is 0.6 years. So how much will I get? I will cover the investment in 2.6 years. That is with X. Then look at Y. Y, how much would I have? It is 5,000. First year, second year 15, third year 20, means cumulative cash flows if I take first year 5, second year 10, 15 plus 5, 20, then 20 plus 20, 40 in the third year, and in the fourth year also I have to go because I want that 50,000. Fourth year I need 10,000. So I require 10,000, right? 10,000, which I require. That 10,000 divided by how much I'm getting in the fourth year? 30,000. 10,000 by 30,000 into, if I take it is around 0.33. That is a quarter. So 3 years, 4 months. I will get in the period of 3 years, 4 months. So now which one is better? 3 years, 4 months in the second, for the second machine. First machine you are getting it in 2 years, 6 months. So which one is better? X is better because you are getting your investment early. X is better because you are getting your investment early, right? If at all there is an even cash flow, I can take it as, see, in the next problem I've given. Project requires initial investment 60,000, yield annual cash flow 20. Directly I'll do 60,000 by 20. I require 3 years. But if the cash flow is uneven, I have to calculate cumulative cash flow and find the period. Did you all understand this method? Shall I move to the next one?
Yes, ma'am.
Right. So profitability period is, you will only calculate the number of years you are going to get. So you can calculate the, yes, madam? Any doubt?
No, I'm continue.
Okay. So you have to calculate the cumulative cash flows. Once you know your cumulative cash flows, you will understand what amount you want. Based on that, you can calculate the months. So this is your payback period. The second method is the payback profitability method, or the post payback profitability method. So here, generally we do is the cash flow which is generated during the economic life of the asset minus your original investment. What is the cash flow which you are generating? Minus the original investment which you have kept, right? You look at the post-back profitability. We'll just look at one problem even in this. So Mohan is a company, again, yeah, the same thing, where X and Y want to be purchased with 50,000, right? I have to know exactly what is my post-back profitability. The project whose actual payback period is more than what has been predetermined by the management will be rejected. That is what I said. Now, every management would have a cut-off period. Say, I want the investment back in 3 years. This depends entirely upon the management's perspective. As our mentalities change, see, some may like to invest and get the return within 2 years. Some may like it is 5 years to be chalega. So it depends upon the management's decision as to how much months it needs to get the amount back. So when I say 50,000 is the amount, right? Which is available. Cash inflows are given. Now they are asking us to find out the profitability payback period. So how you'll do? First to see, look at the cash flows of X. You have 15, 20, 25, 15, 10. Add all these cash flows. How much you're getting? 15 plus 20, 35, 35 plus 25, 40, 50, 60, 60, 75, 85,000 you are getting. So for machine X, you are getting 85,000. Your investment is 50,000. So actual investment 85 minus 50,000, 35,000 you are able to get. You are able to get 35,000. Look at machine Y. It's 5, 15, 20, 20 plus 20, 40, 40 plus 30, 70, 70 plus 20 is 90. So here you are getting 90 and your investment which you're spending is 50. So the amount is 40,000. So machine Y, see, you may, payback profitability is 35,000 for X and for Y it is 40. Machine Y is preferred. If I take time, machine X is preferred. If I take the total return I'm getting, I'll prefer Y. So this depends upon what method we want to use to get our returns back. It is period, we'll go with X. If it is total amount post payback profitability, then we'll go with machine Y. We'll go with the next one that is called as the accounting rate of return.
Conceptualize with the depreciation method, ma'am. Is
Pardon?
it the amount is getting depreciated or what, ma'am?
I will tell you, Nana. See, whenever we go for a depreciation, that sum comes in your time value of money where you have to calculate your cash flows. I'll tell you that also.
Okay, ma'am.
I'll show you that problem also. I'll prepare the table and show you. Even that
Sure,
method is there. Because generally in your exams, you will be getting that type of problems only.
Achha, okay, right.
Right. Then accounting rate of return is the formula is your average annual income by your average investment or original investment. How do you get your average investment? That is original investment by 2. That is what is the formula for accounting rate of return. And how do you accept this? Wherever the accounting rate of return is higher than the minimum rate, we have to accept it. What is this minimum rate? As I told you, the management would have the rate at which it would want to earn. Suppose I say, I have taken from you 1 lakh rupees. You are giving me a 10% rate of interest. I am investing in another company. So surely I'll expect something more. My investment should be more. So my return would be somewhere 13 or 14. So whenever we calculate, we have to see at what rate I am getting my source from. Based on that rate, I would understand what is my cutoff rate or what is my cutoff period, what is my cutoff return. Based on that, we can calculate. So if my rate is higher than the minimum rate, which the management has put as a cutoff, I will accept. Otherwise, I will not. So here, when I look at this problem, determine the accounting rate of return from the following, right? For the machines X and Y, original cost is given, additional investment is given, estimation life of the year is given, salvage value is your resale value or scrap value, salvage value, right? Then income tax rate is given. Now estimated, this annual estimated income after depreciation and tax. We need to calculate. See here, the estimated income is given after depreciation and tax. So your first year, second, third, fourth, and fifth is given for both the machines is been given, right? And they say that depreciation is charged on straight line basis. So what is our formula? Our formula is whatever earnings we get divided by average investment into 100. That is the rate at which we have to see. Now, what is the original rate of investment? We'll just look at the original rate of investment. My original investment is how much I am spending? Original cost is 56,125. 56,125 is the original investment. What is the scrap value which I'm receiving? 3,000. 56,125 minus 3,000. Right? This is by the original investment. Right? By 2. And then plus what is the additional working capital and the scrap value. Here, what is my additional working capital? I'm spending an additional investment 5,000 and my scrap value. This is the formula, Nana. Your average investment, original investment, my scrap by 2 is my average investment. Plus, you need to add the additional working capital and the scrap value also to find out the average investment. So overall, what is my average investment? It is 34,563. Now look at the earnings which we have received. This is total income.
What is scrap value?
Pardon?
What is scrap value?
Scrap value is given in the problem, Nana.
I mean, what is mean by scrap value, ma'am?
Scrap value means after the period is over, you want to sell it. Suppose I'm using a fridge. After 5 years, I will sell this fridge. So some resale value I'll get, right?
Okay.
That is called scrap.
Okay, ma'am.
The amount I would realize after the period, the expiry date of the product is done.
Okay, got it,
That
ma'am.
is called salvage value, scrap value, right? That means what is left that you are selling and whatever amount you get.
Okay, ma'am.
Right. So then how do you get? Now calculate your average income. So when I look at the average income here, my total income after depreciation and tax. How much is my total depreciation after income and tax? In the problem, it has been given. 36,875. So 36,875 I'm getting for 5 years. For 5 years. So average investment is 7,375. No, I don't have your textbook. This is the reference book I'm using. I don't have your material which you have. If you send any problems as such, I want the same problems to be explained, I will explain. Presently, I am using my reference textbooks. I don't have your books.
Okay, ma'am.
Yes, ma'am.
If
Got
you
it.
have anything or if any assignments are forwarded to me, similar type of problems you want to tell me, I will tell you.
Sure, ma'am. Sure.
Right. So my total income by 5 is 7,375. Now, what is the formula then? 7,375 divided by 34,563 average investment. The amount which I got, here divided by the average investment which I got, that into 100 will give me 21.34. Same thing we need to calculate for Y also. Look at the original investment. The original investment I have is 56,125 minus scrap value is 3,000 given in the problem divided by 2 plus my additional working capital is given as 6,000 and the scrap value is 3,000. So add that totally I'll get 26,563 plus 9. Remember the additional value and the scrap value is added at the end again if it is given in the problem. If additional value is not given, additional investment, you don't have to put this plus. This part you need not add. This you will not add.
Okay.
Only you will go with this formula. But additional investment is given, we go with this formula.
Ma'am, I
Are
have
you
a question, ma'am.
clear?
Ma'am, they have given original investment minus scrap value divided by 2. So what does 2 represent over here? It is the X and the Y, the 2 year it is mentioned, or it's like it is only in the formula?
No, sir. This is the formula I'm telling you.
Okay.
And this is the X and Y value which you have to substitute.
Okay, ma'am.
Right? And
Okay.
the thing is, what I want to tell you is, generally the formula is original investment scrap value by 2 is their average investment.
Achha.
But
So
when
2 is
additional
everywhere,
working
2 is
capital-
compulsory, right, ma'am?
Pardon?
I'm saying 2 is compulsory everywhere. Original
Yeah,
investment
that is
minus scrap value by 2
average,
is
no?
compulsory.
That is average.
That is average, right, ma'am?
That is why we are dividing by 2.
Okay. Ma'am, got it. Then I got it. Now it's clear.
And yeah, plus this additional working capital plus scrap value. This will come only if additional working capital is given in the problem.
Okay.
If that is, because sometimes additional working capital will not be given. You don't have to put this part. If it is given in the problem, we have to add.
Okay, ma'am. Okay.
Am I clear?
Yes, ma'am.
Right. So how do I go with? I look at
The second one, ma'am. Machine
Yeah.
Y.
I'm machine Y. Machine Y, my original investment minus scrap value divided by 2, plus I get the original investment. Now calculate the average. Calculate the average investment. Calculate the average investment. I got it. What is my average net earnings? Now divide the whole thing. My net earnings is 36,875, which I received. Same thing like here. 36,875 divided by 5. 7,335. 7,375 divided by 35,563. My answer is 20.74. I got 20.74 here, 21.34 here. Now tell me, according to you, which will you choose?
21, right, ma'am?
Correct. So we will go with Machine X.
Machine X.
If it is based on average return method, we will prefer Machine X. Right. Then we'll go with the next method. You have any queries, you can tell me. Because if you chat, the reason is busy with my showing you the screen and all. You have anything, please unmute yourself and ask me, I'll tell you. Then
No, ma'am. So far it is clear, ma'am.
Right. We'll go with these are the till now what we have done are the traditional methods. Right? And sometimes the average, the annual rate of return is generally asked one. That will be given. Right? That's a very, very common formula which we use. Then we will go with the net present value. Net present value, already we have discussed in the time value of money. That is the reason I wanted to take this class continuation with it. So what is net present value? As we have already discussed, finding out the present value of a future income. So how do you do it? We take the discounted rate, we calculate on that rate, we discount our money, and then we tell exactly what is the present value. If I deduct the present value from the original investment, I will get my net present value. Right. So I look at the present value. We'll just look at it. So the formula there remains same, which I told you. 1 by 1 plus r to the power of n. I was telling you how to use a calculator. The rates are not given. If the rates are given in your book, it's fine. So this is how you calculate. 1 by suppose 10%. 1 by 1 plus 0.10. That is 1 by 1 plus 1.1. If it is 10%, you will get 1 by 1 plus 1, 1.1. If it is 20%, it is 1 divided by 1.2. If it is 8%, it is 1 by 1.08. You are able to get me?
Yes, ma'am.
Right. If the percentage is 10%, 1 by 1 plus r by 100 into n, 1 by 1 plus r to the power of n. R is 10%. So it is 0.10. So 1 divided by 1 plus 0. Pardon?
Can you explain once again, please?
Yes. You were not there in the last class, madam, correct?
Yes, ma'am. We discuss about this one. Ma'am, we do have this one chart also along with us. We can carry the chart in the examination hall, right, ma'am?
Right. You can carry.
We can carry, right, ma'am?
Yes.
Okay.
So suppose I say 8%, it is 1 divided by 1 plus 0, 1 by 1.08. This we have to do to the power of n. Suppose you have your table. You have your tables with you now.
No, ma'am, it's not with me right now. I left behind at my campus. That's the reason.
Fine, fine.
But it is,
If at
I
all
understand.
I'll show you how. You have to have present value table karke rahega. Open the present value table. In present value table, you'll have two tables. One is present value table. One is present value annuity table. We should not take annuity table. Take just present value. In that, you will have the numbers 1%, 2%, 3%, 4% to the horizontal. It will be given to your right. Left vertically, you see years are given. First year, second year, third year, fourth year, fifth year. Suppose I have to see 8%. Then horizontally, I have to see 8%. Stop at 8 or 10. Then I can get the rates. So we'll just look at a problem. You will understand. If we do a problem, it will be clear. All right. So here, a company is planning to purchase a machine. 2 machines are selected for evaluation, each costing 3 lakhs. The cash inflow are expected to be as follows. Machine X cash flows are given. Machine Y cash flows are given. The company expected rate is 10%. Means the discounting factor or PV factor which we have to take is 10%. That is how in the problem you have to identify. The discounting factor is 10%. Evaluate the profitability of 2 machines by taking the present value of 10%. He gave you the values at 10%. He only gave you the values, very good. Sometimes they don't give, you have to use the table. Right. So how do we calculate first? Look at the cash flows. Here, the cash flows. Right. Look at this. The third column, cash flows. Now put the fourth column. We have to multiply in the discounting factor. We have to multiply with the discounting factor. That is 0.909 is the factor. 0.826, 0.781, 682, 621. Look at the second column. Discounting factor 10%. Right? And the cash flows are given as 20, 65, 90, 150, 170. This is a very old type of textbook. Otherwise, in your book, how would it be? Cash inflow is given first, discounting factor next, present value factor, the third column. Anything, it's one and the same. So you multiply 20,000 by 0.909, 65 into 0.826, 90 into 0.751, 150 into 0.683. The third column into second column. Are you all with me?
Yes, ma'am.
Yes, ma'am.
Madam, you are able to understand, right? The third column you have to multiply with the PV factor. PV factors are given. You don't even have to look at the table that's given. It's very easy for us to understand. Now multiply that, you will get a value. Now sigma, that is summation of all the present values. Add all these present values. Okay, all these present values you add, you are getting something 3,50,000 some amount. So that is the amount. Now calculate for Y in the similar position, discounting factor into the cash flows which are given here. Multiply with the cash flow, right? That into this, you will get the cumulative cash flows. Sigma cash flows, summation of the cash flows. You add all that. Now, for this, you are getting the cash flows according to present values. You get the present value, total present values. From that, you have to minus your initial outlay. Your initial outlay will be given in the problem. The order has selected for evaluation, each costing 3 lakhs. So your initial outlay, investment, outlay means investment. What is the amount you are investing for purchasing a machine? So your cash inflow minus your initial outlay will give you these values. First one, it is 50,000 585. Second one, it is 1,37,160. Now, which one we have to select? First rule, acceptance or rejection. For every problem, you have to draw a box and write the decision criteria. Accept the present value which is positive. Now both are positive. The next one, accept the decision which has more positive value. We go with machine 1. These problems are compulsory, Nana. You will get in the exam.
Calculator.
Ma'am, how do we need to calculate the present value of the cash inflow?
That's how do you get this? Your rate is given, discounting factor rate is given, that into cash inflows. Cash inflows are given here, the problem. See, in the top it's given. 1 second.
Cash inflows are given, ma'am, correct? Ma'am, I mean
Yes.
to say the next column. After
Cash
the cash
inflows are
inflow, they're
given.
giving the cash. Ma'am, can you show the slide once again, ma'am?
I will.
Yes, ma'am.
Cash inflows are given,
Yes, ma'am.
right?
20,000,
Outlay is
65,000,
given.
90,000. Yes, ma'am.
Outlay is given. How do you
Outlay
calculate?
is
You
given. Yes, ma'am.
calculate this cash inflows, put it here.
Hmm.
Into the discounting factor, he has given you the discounting factors.
Yes, ma'am. Correct.
These are the tables, table values. Suppose you are having a table,
Okay.
you can see 10% table value will be same values.
Yes, correct,
If
ma'am.
you have the table with you, you can take it out. You can see the same values. So the same values, you put it here, multiply. Now this into this.
Okay. It
Multiply
comes
this
the
into
present
this.
value. If
Yeah. This
Okay.
20,000 cash flow has come.
second one into first one or the first one into first one, ma'am? Which one
Yes.
need to be
Yes.
calculated?
First into first. Second into second.
Acha, first. Okay, got it, ma'am.
20 into 0.909. 65 into 0.826.
Okay.
You get the
Then
value.
we'll be
Add all
getting the
this.
present value of the cash inflow after
Correct.
that we'll be getting.
Now add all this.
Okay.
Summation. You'll get this value.
909 into 20,000.
Yes.
Okay, ma'am. Got it.
You will get these values.
Cha. Got it, ma'am. Got
Right.
it.
The same thing with machine Y also. The same thing with machine Y also.
Yes, ma'am.
You will get the same values. Now multiply with the initial outlay. Initial outlay is given in the problem 3 lakhs. So when you add all the present values, you got 358 to 585. That 3 lakhs ka minus it 5585. And for machine Y, what you are getting? You are getting 4,37,160. 4,37,160 minus 3 lakhs. 1,31,760. Which one is more? 50 lakhs or 137? Whichever is more accepted. What is the rule of the accepting the proposal? First rule, NPV. How do you get your NPV? NPV is total summation of the present values minus the initial outlay.
Acha.
That is the net present value. First condition, present value should be positive. Both are positive here. Second condition, both are positive. Accept the higher one.
Okay.
That's how you go. So this is how you calculate the time value of money also there. In time value of money also the same procedure is used. Here also we are using the same procedure. Did you all get this?
Yes, ma'am.
NPV and IRR generally asked questions in the paper.
Okay. Ma'am, it will be a problematic sum or it will be a theoretical question, ma'am? Because in
Generally
assignment,
problems are given in this. In capital budgeting, you don't have much theory to do.
Acha, because in the assignment, they have given one question, difference between NBV and IRR.
Okay. I will tell you that. Now I'll show you IRR also. Next, when we are talking about the modern methods, we have discounting cash flow or calculating the or adjusting the cash flows according to time. According to time, that is first year, second year. Remember, first year amount, you will get more. Second year, as the time goes, your money value comes decreasing. Get this. Suppose you are getting 1 lakh every year. 1 lakh, today's 1 lakh is equal to 90,000 in the second year. First year. Second year, it is equal to 82,000. Third year, equal to 79,000. Fourth year, equal to 71,000. As you go on, the time value of money comes down. Okay?
Okay,
Yes,
ma'am.
ma'am.
Right. So we will go with this. Now, when I talk about the internal rate of return, because this is very, very important. What is internal rate of return? Net present value. See, we are using the same method. Don't get confused. NPV, time value of money, discounted cash flow, all these are one and the same. Only the terms which we are using is different. So what is IRR? IRR is, here we use the net, same thing. We are using the net present value only. But what is the difference in IRR and NPV? We use the method also, we use NPV method only. But what is IRR? As I already told you, every company borrows certain investment from a certain source. You don't have money every time. The business never has its own money. It has some source from getting the money. Even if it is saving the amount every year, say out of profits, it kept some amount aside. That is called retained earnings. Even that has a cost. Even retained earnings has a cost. Everything has a cost. So we have to calculate what is that rate at which we are getting. Suppose I told you, if I want, I have 1 lakh I've taken from you. You gave me a 10% interest. I am investing it in a business, and that business I'm investing, say, with 12%. Why do I want to invest 12%? I will be benefited by 2%. So that 2% profit is mine. I will return your amount to you. That's what the concept in the business is. So here, when we talk about the internal rate of return, for every amount, we do have a cutoff rate. This cutoff rate is what is the internal rate decided at. They give at the rate at which you would get the finance. Suppose we have calculated, I got my NPV value, or the rate, say, or the amount is around 15%. But I am taking it from you for 18%. Is the project feasible? No. My source is 18. I am getting 15. I am at a loss of 3%. I should not take it. So this is what is internal rate of investment. How do we calculate the internal rate of investment? We do have a specific formula for this. Right? So what is the formula? Difference between calculated present value and required net out cash outlay by difference between the rates into difference between the rate. I'll tell you how. So first, how do you take the lower trial rate? What is this? Internal rate of return is a trial and error version of NPV. A trial and error version of NPV. I told you he has given you 10%. Okay. What do you mean by IRR? IRR is at what rate it is 0. Let me once again tell you. Internal rate of return is at what rate my investment is 0. Means my NPV I calculated in the previous problem. That should be 0. At what rate it is 0. How do I get 0? I can't exactly predict how much rate if I put it to 0. That is why it is a trial and error method. I take 2 rates, compare between the 2 rates, and I calculate it. So how do I take the 2 rates? If you look at this page, you'll be able to get. Here in this page, the cash inflows are given. The discounting factor. Okay. The discounting factor is given. So here we have taken 18 and 20%. The cash inflows are given in the problem. The cash inflow is given in the problem. Discounting factor is 18 and 20, which we want to take. And then we calculate the PV at 18%, 20%. Method same. Cash inflow into discounting factor. How do you get 18% rate? Take out your table. In that you can see 18% 1, 2, 3, 4, 5. You will get the rates. If you don't have the table, you have to calculate 1 by 1.18 is equal to, again is equal to, again is equal to, you will get the rates. Are you all with me?
Yes, ma'am.
Right. If you have a calculator with you, you can calculate. 1 divided by 1.18 is equal to, you will get the first rate, is equal to second rate, is equal to third rate, is equal to fourth rate. That way also you can do if tables are not available with you. If tables are available, well and good. Look at the table, you can write it. So I'll get the present value of 18%. Now for 20%, again, I'll take the cash flows, I'll take the discounting factor and I'll multiply. Same cash flow. Cash flow will not change. Cash inflows are 2,000 per year. That will not change. Only the rate is changing. 2,000 into 0.833, 1,686, 666. Now I calculate for two rates, I get the amount. Now, I have taken two rates, 18%, 20%. How do you know which percent should be taken if it is given in your exam? Generally, 18, 20 is something which he has taken, but one percentage which we take by default is 10%. Okay. If the amount is very high. Pardon? Yes, madam. Suppose you take a percentage of 10%. Suppose you get a positive value of say some 6,000. Yes, ma'am. You do have any doubt or should I continue? Are you able to look at the screen?
Yes, ma'am. Yes, ma'am. Got it, ma'am. Please continue.
Yeah. So you have this 6,285.54. I got it 18%. Okay.
Ma'am,
As you go
2000
on
into
increasing,
18% is 360 आ रहा.
क्या 360 आ रहा है?
ये 20,000, 2,000 into a PV of cash inflow at 18%.
How much you got?
360, ma'am.
नहीं ma. You are multiplying into 18%.
2,000 into 18%.
Madam, please. NPV calculate करने present value factor table देखिए आप. टेबल देखना पड़ेगा 18% का.
Okay.
आपका पास कैलकुलेटर है हाथ में?
Yes, ma'am.
Right. Then do what I tell you. 1 divided by.
Yes, ma'am.
1 divided by. Madam, are you with me?
Yes, ma'am.
1 divided by 1.18 करो.
1 divided by 1.8.
1.18. 1 divided by 1.18. 18% मतलब 1.18.
Yes, ma'am. I got it.
How much you
Thank
got?
0.8474.
One
Yes.
second. आप same figure रहने दो. Is equal to the above? Only put is equal to.
Yes, ma'am.
How much you are getting?
7181.
0.717.
Yes.
Right. Again is equal to the above. Third year का आएगा.
Yes, ma'am. Thank you.
ये
Got
internal
it.
rate of return, madam. You should not multiply into 18 by 100. No. Formula is 1 by 1 plus R. 1 divided by 1 plus 0.18. So it is 1
Ma'am, why
by.
do we calculate 1.18, ma'am? Ma'am, what is the relation?
Pardon?
Why do we take 1.18, ma'am?
That is what I'm telling you, Nana. In internal rate of return, ours is a trial and error base. You can take any two rates. You can assume any two rates.
Okay.
Right? So here is the problem. We took 18 and 20. But generally what I want to tell you is take 10%. If ये problem exam में है ना 10% का ले लो. One you do on 10%.
Okay. Okay, ma'am.
एक 10% लो. You'll get some amount for 10% or 18%. See,
Correct.
for now once listen to me very carefully. 18% का value 6,254 आया plus value.
हाँ मैम 18,000 का कितना आया मैम
18% का तुमको 6,254 आया total sum of all the present values.
Yes, ma'am.
Right. So remember, if you have 6,254, तुमको जीरो करने के लिए बड़ा नंबर लेना चाहिए. Let me tell you once again. अगर 18% का 6,254 आ रहा है, you should go for a higher number where the amount decreases. You take 20%, 5,980 आया, 30 लिया ना और भी कम आएगा, 40 लिया और भी कम आएगा.
Okay.
Are you getting me?
Yes, ma'am.
Yes, ma'am. Yes.
You have to increase the rate. See, sir, increase the rate to make it more, decrease the present value. The more and more you are increasing the rate, the more and more your present value decreases.
Okay.
Okay.
This is the work
So here
criteria.
we have taken 1820. You can take any percentage, your wish. Take any two. 1820 ले सकते, 1020 ले सकते. Any percentage which you like. Generally, 1820 is very near. What I tell my students is, you take 10% का एक ले लो, तुमको amount जो अगर कम आ रहा है, suppose you get 6,000. If it is 0 के लिए, you need to increase, take it 20%. अगर तुमको पहले ही negative आ रहा है, decrease the rate of interest. मतलब 10%.
Okay, ma'am. Okay. Got it. Means we have calculated 18 of 10%, right?
Correct.
Or else we could have taken 20 of 10%. Am I right, ma'am?
Your wish.
Hello.
Okay. Now what
Yeah,
is
ma'am. It's my wish. I can take either of that. Hello.
Pardon, you can take, sir. 1820 is taken in the problem. You can take 1020.
Okay, right, ma'am. Right.
The formula, sir, this is important. Take any rate. Now, lower trial rate. 1820 lower trial rate is 18%. So 18 plus difference between the PVs. Present value of 1820. Present value क्या आया? 6,254 minus 5,980. Okay, so first, sorry, in the numerator you will take 6,252 minus, what is the present value? This is present value 6,254. इसका net present value calculate करो. Net present value is 6,254 minus 6,000. Outlay 254. So 254 divided by the difference between these two. 6,254 minus 5,980. Difference into difference in the rates. 20 minus 18. This is the formula, sir. Let me tell you.
Yes, ma'am. I got it now only.
I'll repeat the formula. Lower rate plus NPV. NPV बोल रही हूं मैं. It is not present value. It is a net present value. Means present value of the lower rate minus what we got. NPV divided by difference in NP present values. Difference in the two values into difference in the rate. We have taken 1820. So 20 minus 18. अगर 1020 लिया 20 minus 10. You will get a rate. Now what is that rate? 19.854. That is the internal rate of return. Means at 19.854, this it becomes 0. Okay? Discounting factor 19.854. Now what is the cutoff factor which he has given? He gave you the annual cash flow is given. Right. He didn't give anything. He just told 19.854. Calculate the internal rate. Generally, how he gives in the problem? For your problem, he will tell you. The internal cutoff rate is, or the management is expecting a rate of 25%. Expecting 25 RI 19. Should we accept? No, reject the proposal. Manager is expecting 15%. Tumko 20 RI answer. Accept the proposal. Did you get me?
No, ma'am.
Yes,
This
ma'am.
concept I didn't get one, ma'am. Can you repeat
I'll
once?
tell you once again. See, how do we calculate now? Based on this, which I tell you, you have this. You get the amount 19.854. This is the internal rate of return. IRR. Okay. 19.854. Now in the problem, he will even ask you, the management's cutoff rate is 10% or 15% or 20. Then the management cutoff rate, your answer should be more. If it is more, you will accept the decision. If it is less, you will reject the decision. Okay?
Okay, ma'am.
Right. So this is how the decision criteria. So NPV and IRR one and the same. Only IRR, you have to calculate 2 NPVs and put it in the formula. Take any NPVs. Don't worry with that. 18 लेना, 20 लेना, 10 लेना, 30 लेना. Don't be confused. जो तुमको आया तो rate लो. दो rate लेके calculate कर दो. And then you put in this formula, you will get the correct rate. That is your IRR. So these are the methods in your capital budgeting. This is what we have. This is the difference between NPV and IRR, which you are talking about.
Have given, ma'am.
Right?
Made in a comparison between MPV and IRR.
So this is what it is. In NPV, we are using IRR also, we use NPV only. But the interest rate is known in NPV. Here we don't know the interest rate.
Okay.
That's the base difference.
Okay.
And you compare it with the cutoff rate which you get.
Okay,
Okay?
ma'am.
So this is here, you would get problems from NPV and IRR. More than IRR, generally NPV is asked. Even IRR could be asked. So these are the two problems which you can expect from this chapter.
Okay, ma'am. Done.
Right. Then I shall end my class here. If you have any doubts or you want to learn some topic, if you post me your assignment or something, I will tell you, I will take the same thing in the next class.
Okay, ma'am.
Sure, ma'am. Noted.
Right then. I'll end my class here.
Okay. Thank
Sure,
you, ma'am.
Thank you so much, ma'am.
Thank you. Thank you.
Hello. Is anybody there?
దీప్తి
Yes. Next class is 3 p.m., right?
ఉన్నదా నెక్స్ట్ క్లాస్ ఉందా
నేనే అడుగుతున్నా 3 p.m. కుంది కదా అని.
3 PM కు ఉందని అంటున్నావా